بسم الله الرحمن الرحيم. الحمد لله والصلاة والسلام على نبينا محمد وعلى آله وصحبه أجمعين. السلام عليكم ورحمة الله وبركاته. Today's topic is the weighted average cost of capital and company valuation. So at the beginning we will talk about weighted average cost of capital. We also call it WACC. Then at the end of the lecture, inshallah, we will talk about company valuation. Yeah, is my voice clear? Is my voice clear? Okay, so you can write for Layla. She can go out and come back again. Okay, let's start. First of all, I add this paragraph that I highlighted in green color just to make it easy for you to understand WACC. Okay, WACC is the cost of raising fund needed to operate the firm or invest in a project. Okay, WACC, like when we invest in a project, we need money, right? So we need to raise money actually to finance our activities, to finance our new projects. Now when we raise money, we raise it from different sources, not just one source. One source from money is to take loan. Another source is to issue bond. Another source is to issue shares. So now we have many sources for fund, and the cost of raising money from different sources, we call it WACC. So remember, WACC at the end for the company, it represents cost, how much it costs us to raise money from different sources. For example, if WACC is 10%, it means it costs the company 10% to raise money from the bank or bond or shares or all of them. Okay, so WACC is the cost. Also, WACC represents the required rate of return on a firm of projects. Can be calculated using the weighted average cost of capital. Now here we said cost. We said also it represents required rate of return. Why? Because to me, as a firm or as a manager, if the cost of raising money is 10%, this means at least I need to generate return from the project equal to 10%, so I can pay my cost. Okay, so we know WACC is the cost of raising money, but also I can consider it as my minimum rate of return. This is the minimum I should generate from project in order to cover my cost. Now the weighted average cost of capital is the after-tax return that company needs to earn in order to satisfy all security holders. So this is similar to what I said before. This is what we need to earn or to generate in order to pay a bondholder, for shareholders and for banks. Okay, so here we're repeating the same idea. Same when we say WACC, we call it also the opportunity cost of capital for the firm's existing assets, and this represents the minimum acceptable rate of return when the firm expands by investing in average risky a project. Okay, so this is how much should we earn in order to cover our cost. I will give you example again, like if a company has WACC equal to 20%. This means the cost of raising money to finance a project is 20%. And at the same time, this means I need to generate at least 20% from the project. So I have a profitable project, otherwise I will lose money, right? I will lose my money. So I need my return to be at least equal to the cost. It should be higher, but at least equal to the cost. Now we will talk about capital structures when we hear this word, capital structures. Okay, this means the mix of long-term debt and equity financing. This is the main source. Okay, we have debt and equity. Example of debt financing, long-term loans, and another example, bonds. For equity, we have common shares and we have preferred shares or preference shares. And today we will learn how to calculate WACC using this two different sources, inshallah, and like why we need WACC. Okay, we want to know why we need WACC. So why we need it? We use WACC to value new assets that have the same risk as the old one. Okay, and we have example, inshallah. Okay. Okay, after this slide, the company cost of capital is a weighted average of returns demands by debt and equity. So you can see in the formula in this slide, R for assets equal to D divided by V multiplied by R of debt. So this is the first part of the formula. Then the second part, we will do the same as the first part. But the second part, we are talking about equity. So here we have E divided by V multiplied by R equity. And the explanation is here in the slide. When we say D from the name, this is the a market value of debt. E is the market value of equity. V is the total market value of the firm. V means the total value. You add debt plus equity. So this is the explanation of DVE for R. R of debt means required return on a firm's debt, required rate of returns for debt. R equity from the name, R return of equity. R assets, required rate of return for all assets. We have example in the next slide. Okay, Microsoft has issued long-term bonds. That's okay, we're done. Okay, Microsoft has issued long-term bonds with a present value of 25 million and a yield of 8%. It currently has a 20 million shares outstanding, trading at $20 each, offering an expected return of 14%. And the question is, what is the firm cost of capital? Okay, so here we will use a previous formula. Okay, and actually I copy it here in this slide. So first of all, we need the D, E and V, the three items. So D from the name, this is for debt. What is the value of debt? According to these questions, we know bond is an example of debt, right? This value is the value is 25 million. So this is ready from the questions. Equity, we don't have it as a dollar amount, but we know from the questions we have 12 million shares. This is number of shares. Each of them is $20. So think of this one. We have 12 million shares. Each of them worth $20. So if you multiply 12 million by 20, this is 240 million. This is the value of equity. Now we know debt, we know equity. 240. If you want the value of the whole company, it's equal debt plus equity, which is 25 million plus 240. The answer $265 million. Okay, now we will use this formula. First of all, we need to divide D by V. D is 25, V is total 265. Now R of debt, required rate of return of debt. You read the questions again. Debt is a bond, so we have it here in the questions is 8%. For equity is 14%. The answer will be 13.43. This is the how we calculate the WACC. Now, for proper valuations, we must value the firms as after-tax cash flows. So everything should be after tax. Now, why is important to account for taxes? I added those answers for you that I highlighted in equal color. First of all, most companies are financed by both debt and equity. If you check in real life, most of the companies, they use a mix of debt and equity. So you cannot find actually any company that finance their activity only using equity or only using debt. they always use a mix of debt and equity. And we know the interest payments on debt are deducted from the income before tax. So the interest expenses are tax deductible, which means this will reduce your tax. Therefore, the cost of or to the company is reduced by the amount of their saving. So for me, when I take a loan to finance my activities, I will pay interest. Those interest expenses will reduce my tax, which means like I saved a specific amount of money. That's why we need to include this is in our calculations, okay? And you will see in the next slide, inshallah, we have the correct formula for WACC. Actually, this is the correct formula for WACC. Here in the formula, we add 1 minus tax. So in the previous one here, this is not correct one. This is, you can use it if there no tax. If the country don't have tax, we use this formula. But if there is a tax, you use this formula. The WACC provides a firm after-tax cost of capital, WACC. So this is a formula exactly similar to the previous one. The only difference we add here in the formula 1 minus tax for the debt, okay? Only for the debt, because as I said before, the interest rate is tax deductive, okay? For share or equity, no adjustment. There is no tax deductions. Okay, now how to calculate WACC? A firm WACC is calculated in 3 steps. Always when you calculate WACC, you need to follow 3 steps. The first one, calculate the value of each security as a proportion of the firm value. So first of all, we need the value of each source of financing. When we say security, we know in the finance we mean shares and bonds, right? So we need the value of shares and the value of the bonds, and we write it as a proportions. Later on, inshallah, you will see in the example. So this is a first. The second one, we need the required rate of return for each security. Required rate of return for bonds and for shares. Then once you have the first one and the second one, you can calculate the weighted average after tax WACC. Okay. So let's start. We have one example here. What is the WACC? So the question is clear. What is the WACC for a firm with 30 million in outstanding debt with a required return of 8%, 8 million in equity shares outstanding, trading at $15 each with a required return of 12% and a tax rate of 35%. So you can see from the questions, we have 2 sources. We have debt and we have shares and we have information for each of them. Now, we will follow this formula that I copied here in this slide. So I need DV and E, the amount of debt from the questions, 30 million. The amount of equity not given in these questions, but we can calculate it. $15 each shares, and they have 8 million shares. If you multiply them together, 8 multiplied by 15, this will give you 120, which means the value of the firm, you add this two, D30 plus E 120, it's V 150. So we are done with the first steps here, which is to calculate the value of each type, right? Okay, so now we know debt, equity, and value of the company. Okay, the second steps, we need the required rate of return. Okay, so for debt, it's given, right? Required return is 8%, so we call it RD. For equity, 12%. And the taxes, later on, you will put it in the formula. So the third step, once you have the first and second, you put it in the formula. D is 30 divided by V, 150, multiplied by 1 minus T, means tax, which is 35% from the questions, multiplied by R, debt, and the same for equity. The answer, 10.64. This is how we calculate WACC and always we need to be organized like this step 1, 2 and 3. Okay, now if there are 3 or more sources of finance, then we can calculate again WACC in the same way, but we will add another part in the formula. So in the previous example or formula, okay, we assume we have only 2 sources, right? Okay, debt and equity, but sometimes we have 3 sources, right? So here, that like in this formula, you have debt, you have equity, which is common stock, and sometimes we have preferred stock. So you add another section for preferred stock, similar to the common stock. So this is in case you have preferred stock. Example, consider a firm with 8 million in outstanding bonds. So we have bonds, 15 million for common stock, 5 million for preferred stock, and require the rate of return is 8, 12 and 10% for the 3 for that their like respectively. Okay, so you can see when you have example like this, always highlight the keywords, okay, which is bond, common stock, shares. Step number 1, the value of each of them. The value for bond is given 8 million, for common stock is 50 million, given is ready. 5 million for preferred stock is ready. They add all of them, $28 million, right? So this is the value of the firm. For required rate of return, all of them given from the questions. Then you put them in the formula and the answer is 9.7%. So this is WACC, okay? Now what does this mean, 9.7? This means the cost of raising money from all sources, which is debt, which is bonds, common stock and shares, is equal to 9.7. So this is how much it costs the company to raise the money to finance the project. So this is my cost, and this is 9.7. I consider it as a minimum required rate of return. I should or I must generate or earn from the project in order to pay it for bonds, okay, common stock and preferred shares. Okay, now we use WACC to calculate the MBV. Okay, and MBV you learn it in Finance 1, right? Principal Finance 101. Now, in our previous example, we calculate the firm's WACC to be equal to 9.7, right? If you remember this one, 9.7. So now the question is, would MBV positive or negative if we invested in a project offering 9% return? So imagine if we use the money that here in this example, okay, the previous example, we raise the money which is 8 million, 15 million and 5 million together. How much? 28 million. If you like we use the 28 million, okay, in a project that give us a return 9%, is good or bad? Definitely is bad. Why? Because the cost of raising money is 9.7, but my return from the project is 9%. In this case, you will have a negative MPV. You will lose some money. But if you invest the money in a project that provides you with a 10% return, this is good, right? It is a good project. Why? Because the return is 10% and the cost of raising money is 9.7. So we will make a profit and we will have a positive MPV, right? If we invest the money in a project that provide exactly 9.7% return, in this case, we will have zero MPV, okay? Because the return is equal exactly the cost. Okay, so no profit and no value here. Now again, I will talk about the value, like how to calculate the value for debt and equity. Remember, when we estimate WACC, when we calculate WACC, we need always to use market value, not the book value. So we need the market value of debt, the market value of equity, which we were using before in all our examples. How to calculate market value of debt? It is equal to the present value of all co-bonds and the principals that discounted at the current yield to maturity. Okay, market value of equity simply is equal to the price per share. You multiply by number of shares. So for each example, how much the number of shares multiplied by price. Okay, this will give you the value. This is in case the value is not given. Now in the previous example here, the value was given here, right? 50 million is ready. But in the previous, in the one before, which is here, if you remember, okay, it was not here in the questions, right? It was only $15. This is a price. We multiply it by 8. We said 120. So if the value is not given, always the value for equity is equal to the number of shares multiplied by the price, the market value of the price, like the current price, okay, which is mentioned here. So like for equity, it is normally given in the questions, but if it's not given, we will use the present value of coupon and the principal, okay, and we will have example in the next few slides inshallah, which is this one. If a firm's bonds pay a 5% coupon and mature in the 3 years, what is their market value? Assuming a 7% yield to maturity and assume the bond has a $1,000 bar value. So in Finance 101, Principal Finance, you learned how to calculate the value of the bond. And here we have examples, okay? So we have 3 years. Coupon is 5%. 5% multiplied by face value 1,000, okay? So it is 50, right? So this is the first coupon, 50. Then you will receive another 50 in year 2. So the first one, it is in year 1. The second one will be year 2. The third one will be year 3. Then remember, in year 3 also you will receive the bar. So this is how the bond working. You will receive coupon each year. Then the last year you will receive the coupon plus the principal, which is the face value. Okay, so we have it here. Then because we are looking for the present value, we need to discount each of them, right? So what was the interest rate here? 7%. So you divide it by 1 plus r, like it's be 1 plus 7 to the power of 1 because the first year, and this is the power of 2 the second year. The third year it will be power of power 3. Okay, the answers, if you do the math, okay, it will be 947. So this is the value of the bond. So to summarize, we know how to calculate the present value of debt. For share, it's easy. You multiply price by number of shares. Here in this slide, we will talk about return, because we said in the step 1, we calculate the value for each component or for each part. Step number 2, we need to return for each part. So here we will learn how to calculate return for bonds, for common stocks and for preferred shares. Okay. For bond, the expected return in bond, this is equal to what? This is the yield to maturity, which represent an investor expected return on the firm bonds. So when we calculate the expected return in bond, this is the yield to maturity, okay? So in the previous example, which is here, you see this one, 7% yield to maturity. This is the return of bond, okay? Now, for common stock, you need to calculate it. There is 2 methods to calculate the expected return for common stock. As I said, all of them, you will read it in Principal Finance 101. I just will give you a quick refresh for this one. For common stock, you have 2 methods. The first one, you can use a KAPM, Capital Assets Pricing Model, which is we covered it in the previous topics. So this is the formula for KAPM. Take this example. A firm beta is 1.5, treasury bill currently yield 4%, and the long run market risk premium is 8%. What is the firm cost of equity? So the questions, what is the cost of equity? Now we are talking about equity. Following the formula, you need the risk-free, which is treasury bills 4%, plus we have beta given in the questions 1.5. Then we have RM minus RF, which is the market risk premium. We call it actually these two numbers, we call it market is the premium. The answer is 16%. So this one way to calculate the return on common stock. The second method to estimate common stock is this formula. We call it DDM, which is equal to dividends next year. So dividends 1 means dividend next year. Dividend by the current price plus growth. Let's take this example. A firm shares are trading for $45 per share. The firm expected to pay $2 dividends at the end of the year. What is the expected return on equity assuming 9% constant growth? All information is given. The dividends given $2. The current price, the price of the share is trading currently at 45, and that is 9% growth. The answer 13.44%. So this is a second approach to calculate common stock return. The last component, we have preferred shares or preferred stock. Preferred stock normally based fixed annual dividends is no more than a simple perpetuity. Okay, so I mean you can treat it as a perpetuity and use the perpetuity formula which is learned in the previous topics or previous units. Okay, simply to calculate cost of preference shares, it's equal dividends divided by current price or preferred shares. We have example in the next slide, inshallah. Okay, if a share preferred stock sells for $40 and its base dividends $3, what is the expected return on the share of stock? You just divide the two numbers following the previous formula. I copy it here for you. So dividends at the top divided by price is equal to 7.5. So this is how to calculate the return. Okay, so just before we go the last few slides, I just want to remind you the steps again for WACC. Okay, which is here. We have it here. Yes. Okay. So first of all, we need the value for bonds and the value of shares, right? So the value for bonds, we learn it. There is one example, we took it already. The value for shares simply equal number of shares multiplied by the price of each shares. Okay, for required rate of return. For bonds, it's always equal yield to maturity. For common stock, you have two methods. Either you use KABM or the dividends method. Okay, for preference share we use the perpetuity formula. Okay, then the last step, this is just you put it in the formula. Okay, now there is some theory here about WACC. Then we'll move to the evaluation. WACC pitfalls. Sometimes the WACC is appropriate only for projects that have the same risk as the firm existing business. Okay, so what does this mean? If WACC equal, let's say 10%, if the current WACC equal 10%, we can use this WACC to value future project only if the risk of the future project is the same as the risk of the existing project. Okay, because WACC reflect actually the risk of the company. If WACC is 10%, you only can use this WACC for future projects if the future projects have the same risk as the current project. If the future project has higher risk compared to the current project, then we need again to recalculate WACC. Okay, and here we will say there are adjustments. Sometimes you need to upward or downward adjustment for WACC. Firm that use WACC as a company-wide benchmark can adjust the rate upward for an unusually risky project and downward for unusually safe project. Like so, if the current WACC is 10%, but we know the future project is riskier, you can increase WACC. You can use, for example, 12% WACC instead of 10, right? If a future project is safer than the current project, you downward WACC, like you use maybe 8% instead 10, for example. Okay, so this is one way. Now let's talk about alternating capital structures. We know when we say capital structures, we mean debt and equity, right? So if the firm changed the proportion of or the amount of debt and the amount of equity in the capital structures, this will have actually some cost on the company. We have explicit cost and we have implicit cost. Okay, I will explain it. Okay, the firm should not alter their capital structures in order to manipulate WACC. So why? Because if the firm increases its borrowing to lower its WACC, the lenders will likely demand a higher rate of return on debt. Now, if the company wants to use more debt because this would reduce WACC at the end, like if you use more debt and you put it in the formula because there is some tax benefit, this will reduce for your WACC, right? But remember, if the company uses too much debt, then the lenders or bankers will likely demand for higher rate of return or higher interest rate on debt, so there will be no benefit from using more debt, right? Okay, so this is actually the explicit cost, okay, which is the interest rate from the bondholder or from the lender or from the bankers. They will increase the interest, but also there is some implicit cost, because when you use too much debt, even the shareholder will ask for higher rate of return. So shareholder will say, this company is riskier, you need to compensate us, or they will ask for higher rate of return. Okay, this example similar to the previous example that I explained it to you, so no need to go through it, you can just read it. It's easy. Now, evaluating entire business. How to evaluate the business? We can treat companies like Gantt project and value them using WACC. Remember, we always use WACC to discount the future cash flow. And one way to value the business is to calculate the present value of all of a free cash flow. So why free cash flow? Because free cash flow is the cash flow that is not required for investment. Okay, so those cash flow that is not required for investment in fixed assets or working capital, and therefore is available to investors. So free cash flow, from the name free, they are available to be distributed for investors. So when we calculate the value of the firm, we use this one, free cash flow. Okay, this is the formula to a value of the company. If you need or if you want to calculate the value today for the firm, it is equal to FCF1 minus free cash flow next year. 1 is next year. Then you divide it by 1 plus WACC to the power of 1. Then again, we will repeat this one for year 2. It will be actually cash flow 2, year 2, till you reach the last one, the last year, okay, in the questions. Okay, so let's call it H or N. So it depends on the question. If you have 2 years, you use 2 years. If you have 3, 4, you will continue the same things. Then remember also, we will have another component here in the formula. The component, we call it horizon value. To calculate this one, we normally do it in the side, okay? Then we put it in the formula. So if you want to do this one, the VH, we will calculate it here in the horizon value formula. It's equal to free cash flow in the last year. You put it, the growth with it, okay, divided by WACC minus G. This is the formula, and we have example in the next slide, inshallah. Okay, use the following information to calculate the value of the business that your firm is considering acquiring. Firm's WACC is given 12.5%. Firm's cash flow also given here. So let's read this one inside the box. For free cash flow, there will be 1 million free cash flow. This is from year 1 to 4. So in year 1 you will have 1 million. Year 2 the same. Year 3 and year 4. Each year you will have 1 million. Then in year 5 we will have 1.05 million. So this is only for year 5. However, this cash flow is here in year 5, right? Will grow at 5% forever. So after 4 years, this will be forever 5%. Why forever? Because we always assume firms will stay forever, right? Always. This is one actually of the principle in accounting. So let's go here in the last slide. This is a formula from the previous slide that I highlighted in a purple color. Okay, basically here we have 1 million each year, right? From 1 to 4. So you put it here in the formula from 1 to 4. So 1 million, 1 million, 1 million, 1 million. You divide it by 1 plus WACC. Okay, so according to this formula here, okay, WACC was given is 12.5, right? Okay, so you can put it in the numbers in the formula and get the final answer easy. Now the last one in the formula is a tricky little bit. Okay, as I said, this part you can do it in the side. Okay, the one in the top. So here, okay, it's similar to this formula. So you need the last cash flow, multiply it by 1 plus growth divided by WACC minus G. Okay, so which is here. So the last payment was 1,050,000. Okay, so according to the questions here, 1,050,000 divided by WACC, which is given in the questions, minus the growth interest rate, which is given. So once you find horizon value, you divide it by 1.125, 1 plus WACC. Okay, so it's like you can do this one on the side once you have the number, because this will give you only the number when you calculate it. Once you have the number, you put it here in the formula. This is the present value. Then you divide it by 1 plus WACC. The answer here 8,462,000. So the value of the companies is almost 8 million and half. This is for all for today. So thank you so much for attending the class, and I will see you next week inshallah, because actually this Wednesday we don't have any class, it's holiday. Okay, okay. Assalamu alaikum wa rahmatullah wa barakatuh. See you inshallah next week. Assalamu alaikum wa rahmatullah wa barakatuh.